Hello and welcome to First Bank's Center for Family-Owned Businesses webinar series. I'm Mike Vanderveld and I'll be your facilitator. Tim Fogarty, the Managing Director of the First Bank Commercial Team, is also on hand. Today, we'll explore the topic of company transactions with our special guest from the Fortune Group. Just a quick reminder, the lines are muted, but at any time, please send us your questions through the webinar tool. And keep your mouse handy. We'll be conducting just a couple of polls just at the start of the presentation. But at this time, I'm going to pass it over to the host of our program, Mr. Joe Ambrose.
Thanks, Mike. Good day to everyone and welcome. I'm Joe Ambrose, Executive Director of the First Bank Center for Family-Owned Businesses. Through the center, First Bank takes a holistic view of family-owned enterprises and delivers services to them beyond traditional banking products. These services are centered on insight and advice that address the family component of family-owned businesses. Today, we welcome John Hull of the Fortune Group. For over 25 years, John has been advising middle market companies on a variety of transactional matters from M&A to capital raising. John's presentation today will focus on how to expand your family business holdings through acquisitions. On the other hand, if your strategy is the sale of your company, John will address that as well. And now, without further ado, John Hull.
Good morning. My name is John Hull, and I have been working with family-owned and middle-market companies for over 25 years. I started my career as a commercial lender and then moved on to practice as a transactional attorney. And for the last 22 years, I have been working as an investment banker with the Fortune Group. Next slide. The Fortune Group is a boutique investment banking firm that focuses on assisting privately owned middle market companies and their owners with M&A transactions. We work with clients in a variety of sectors, including manufacturing, healthcare, consumer products, business services, and distribution. The Fortune Group is proud to be a founding member firm of the Alliance of International Corporate Advisors, or ICA. Founded in 2009, ICA is an integrated global network of middle market M&A firms that provide advisory services to assist clients on both domestic and cross-border transactions. Next slide. This slide, there's a few transactions, represent a few transactions that the Fortune Group has worked on in the past. If you're familiar with the St. Louis area, you'll probably recognize a few of these companies, such as Renoco, Warenberg, and Spectrum Brands. And if you have a dog that sheds, you might recognize Firminator. And if you don't, you might want to check that one out. Next slide. So now that you know a little bit about me, I would like to learn a little bit more about you. We've got a couple of poll questions that we'd like for you to answer today that will help me better understand today's audience and the types of transactions that you're interested in. Are we ready with the poll?
That we are. So go ahead and click your mouse and on the answer that best suits you. Are you planning to complete a transaction in the next 12 to 24 months? It's a simple yes or a simple no. And let me give you about 15 seconds to go ahead and input your answer there. All right, the answers are still rolling in here, so we're going to give you another 10 seconds or so. All right, the numbers are still moving, but it looks like they're settling in. So I'm going to go ahead and close the poll now. The final results are 27% said yes, 73% said no. So let me close that, and then we'll go straight into the second poll. And this is for the yes people. If you are planning to a transaction, are you planning to buy or are you planning to sell? So let me go ahead and launch that now. And again, if you are one of the yes folks, you're thinking about doing a transaction, is it a buy or is it a sell transaction? And again, this will just kind of give us an idea of where you are right now in your mindset and help John with his presentation. So let me give you another 10 seconds here. All right, the numbers are still moving a bit. Okay, so the buys started off leading the race, but now it's settled the other way. So we are at 25% on the buy side, 75% on the sell side. So let me go ahead and close that down, and we will go back to the presentation.
Okay, thanks, Mike. Next slide, please. So regardless of whether you're contemplating buying or selling, there are a key group of factors that should be identified and evaluated in connection with making that decision, regardless of whether the decision is to be a buyer or a seller. Based upon poll results, it seems like potential sellers make up a larger percent of the audience than do buyers. So I will try to make sure to address comments affecting parties considering selling their business, as well as focus on the factors as they relate to buyers. Generally speaking, in a transaction involving a privately held middle market company, the primary factors that influence and ultimately determine whether a transaction occurs, and if so, on what terms, can be grouped into some broad categories. There's some financial factors, non-financial factors, competition, timing, and structure and tax. I'm going to spend most of my time discussing the first four factors, but if we have some time at the end, I'll also dive into some structure and tax questions. Ultimately, your ability to obtain the underlying information pertinent to these factors and properly assess it will determine the success of your transaction. Next slide, please. The primary consideration in a decision to buy or sell is the underlying financial performance of the business. Buyers are typically looking to acquire a profitable business that has good future prospects. Sellers understand that their business will be more attractive if they record and present to buyers a strong history of performance. Valuation is typically based in large part, if not exclusively, on the profitability of the acquired business. So with financial information playing such a large role in the transaction decision-making process, it seems that financial statements that provide a complete and accurate picture of acquired businesses' operations and profitability would be an imperative to consummating a transaction. Unfortunately, in many transactions, obtaining a complete and accurate financial picture of the selling company can be very difficult and sometimes virtually impossible without the seller's cooperation and the buyer's expenditure of a significant amount of resources. So why is obtaining reliable financial information so difficult? Well, in my experience, there's several reasons. The first reason is the company just has not invested in the resources, whether it be people and or systems necessary to produce good financial reporting. That can be because they don't value financial reporting, because none of their third-party relationships are requiring them to produce and deliver good financial reporting, and they just don't find it necessary to operate and manage their business. A second factor is that privately owned businesses typically focus more on avoiding taxes than maximizing profit or even accurate accounting, as long as it complies with IRS regulations. That can skew things, particularly when you're trying to put, for a seller, when you're trying to put the best spin on things, having a tax focus or relying exclusively on your tax returns to present the financial picture of your business can be very misleading and can be detrimental. A third reason is business owners sometimes are reluctant to share financial results. There's just a confidentiality concern. It's usually around competitive reasons. They can be very private individuals, and more often than not, they fear that this information could maybe fall into the wrong hands and that a competitor, a customer, vendor, otherwise could obtain that information, and that they could lose some competitive advantage, or a customer or competitor could gain competitive advantage based on the information. The last reason that reliable information is oftentimes difficult to obtain is many businesses are on a cash basis accounting system rather than accrual accounting. A cash basis system can skew results, whether intentionally or unintentionally, and make period comparisons difficult, if not impossible. Accrual accounting tries to recognize revenues and expenses when they are incurred, regardless of when payments are received or payments made. Cash basis is focused on the date of payment or receipt. So that's one of the important things to always consider as a buyer, is the type of financial reporting and whether you can rely on that, or whether you're going to need to invest some time and potentially some money with a financial professional that can help recreate the financial statements, the seller's financial statements, to give you a good picture of the underlying performance. While the focus of this slide is on the buyer's financial information, sellers should understand that investing resources to be able to provide complete, reliable financial reporting is one of the best investments they can make to improve the attractiveness and value of their business. Having an outside accounting firm prepare reviewed or audited financial statements is one of the first things that we recommend to our selling clients. So many of you are probably familiar with the term EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA is a leading metric for valuing companies, and for that reason, EBITDA is probably the most important financial factor for both buyers and sellers. EBITDA is a very useful tool. However, it may not fully account for capital expenditures, and thus sometimes buyers will look at other metrics. EBIT, which would be earnings before interest and taxes, or free cash flow. This is particularly true when the seller's business requires significant and ongoing capital expenditures that wouldn't be captured by the EBITDA, or fully captured by the EBITDA metric. Adjusted EBITDA, or EBITDA after add-backs, or that include add-backs, is commonly used to normalize EBITDA for expenses that the seller company, or the selling business, feels wouldn't occur or wouldn't be required under new ownership. Such expenses include non-business owner-related expenses and non-recurring or extraordinary items. A couple of examples of the non-business items are owner-related could be vehicles that the owner or management uses in connection with the business for both business and personal use. There could be other things where relatives hold nominal positions with the company and are thus on the payroll. There could be some other entertainment type expenses that could also come into play. Those would all be things that would be subject to and legitimate to add back to EBITDA to give a more accurate picture of the company's earnings capacity. Non-recurring expenses are things that are one-time or very infrequent, and they could include things like the cost of registering IP, sometimes litigation expense, and most recently, PPE expenses are something that we're seeing come up as being identified as non-recurring or one-time expenses that are being added back to EBITDA or considered an add back. Sellers can get very creative and pretty aggressive with their defining and use of add backs. But I would caution sellers to be careful about pushing that too far, because you can undermine the credibility of other legitimate add backs that you're seeking to assert. And in worst case scenarios, you might undermine the credibility or legitimacy of all the financial information that you're presenting to a buyer. Buyers, you should be cautious and carefully evaluate these add backs don't be afraid to ask for documentation to support the add backs that a seller is claiming, and then do your own analysis in terms of determining whether this is expenses that you would in fact incur if you owned and operated the business. Having defined EBITDA, it's important to note that all revenues and earnings are not the same. Quality equates to sustainability, reliability, and diversity of the revenues and earnings. For example, recurring revenues from a contractual obligation are different and more valuable than one-time revenues from a short-term project. A product or service line that has a demonstrated history of demand over a number of years is more valuable than a fad or fashion-dependent product or service. Again, in the current market, in the current environment, mask might fall into that more fad or fashion-dependent. Hopefully, here in the next few months, we're all going to stop wearing masks and no one's going to be buying masks anymore. A large number of customers is better than a small number of customers. Sometimes you see that as referred to as customer concentration. Creates additional risk there and would be considered to be a lower quality earning or revenue source. And then last, a wide offering of products or services is better than a single or small offering of products or services. And in some cases, particularly newer companies may have a single product line that is doing extremely well, very profitable, and growing nicely. But as we all can see, there's quite a bit of risk associated with that. And so they would not deem to be as quality. Those earnings would be lesser quality than a wider offering of products and services that are diversified. All of these things should be taken into account when you're looking at EBITDA. Buyers should consider obtaining a quality of earnings report from an outside provider to help better understand and assess the sustainability of sellers' revenues and earnings, particularly if one or more of the characteristics just discussed exist in the buyer's financial statements and operations. Sellers should be aware of the quality factor as well and recognize the value of their company that the value of their company could be adversely affected by poor quality earnings. We oftentimes recommend that sellers, in advance of beginning a sale process, engage and conduct their own quality of earnings project or report in order to help them identify areas that are weak and that they could work on to improve in advance of a sale of their business. And while earnings are important, the balance sheet must be also analyzed to determine how much working capital is needed to generate earnings and to confirm that a selling company has sufficient working capital to do so. This is particularly important when a company is growing rapidly because their need for working capital will obviously increase as the company grows. The key components of working capital for most privately held businesses are inventory, accounts receivable, and accounts payable. Inventory turnover, the average collection period for accounts receivable, and the payment terms for accounts payable will dictate a company's working capital needs. If a company has rapid inventory turnover, quickly collects its AR, and can stretch out its accounts payable without harming supplier relationships, it can limit the amount of working capital necessary to run the business. And so as part of a buyer's diligence, checking on all those things to understand how the company is performing in those areas could give some insight as to the proper level of required net working capital. Net working capital is usually measured in the context of a transaction as one of the key non-price terms that buyer and seller need to agree upon. And that measurement usually occurs by looking back anywhere between 12 and 24 months to eliminate any seasonality that may be required in connection with the seller's working capital requirements. Once that's established, and that required level is established, it becomes included in the purchase agreement and the terms of agreement, and any deviation from that negotiated level of net working capital will typically result in an adjustment to the purchase price. Next slide, please. Growth is closely correlated with building value. So successful transactions often hinge on identifying opportunities and explaining how such opportunities can be achieved. Buyers should investigate growth opportunities, and sellers should be prepared to share them with buyers. A budget or forecast, particularly a longer range forecast, are good places to look for growth. Forecasts should list assumptions for growth and where growth will come from. If a company lacks a budget or any kind of forecasting tools, it might indicate that there's not much growth expected or going on. Or it could be there are growth opportunities, but they've just failed to plan for how to achieve and to take advantage of the growth opportunities. In either case, those can be concerns, but as a buyer, to the extent that you can identify those and plan for those, that can be an opportunity and that you should consider in connection with evaluating a purchase. Scalability is a word that's frequently used in connection with growth. Basically, it means, can you grow by adding or investing additional resources? Or is there some limitation that will lead to a diminishing return, such as the size of the market, demand for the product? Economies of scale create increased profitability as business grows. Kind of the opposite of diminishing returns. And those are very important and very powerful. So to the extent that a business is scalable and there are economies of scale, there will be huge returns to a buyer if they're able to grow the business after acquiring it. It's important to understand and analyze the scalability and economies of scale when assessing growth opportunities. Next is synergies, and probably most of you are familiar with the term synergies, created when a buyer can provide to the selling company or to the target resources at a lower cost than the selling company is currently able to provide or obtain them on their own or under current ownership or management. You know, those things can be everything from personnel to facilities to equipment to purchasing. The greatest opportunity for synergies really exists when the buyer and seller are in a similar business or acquiring or purchasing products from similar vendors. Measuring synergies can be difficult. Buyer is typically in a better position than seller to determine the synergies because they understand what they're currently doing. They understand how they could fold operations into the seller's business, into their business. They know where there would be duplication and where they already have systems and people capable of handling that. So sellers are at a little disadvantage, and for that reason, in part, the discussion or the negotiation around who captures the value of that synergy can be hotly contested and during the negotiation of a transaction, and can have some significant impact on valuations. Buyers will usually claim that it is their resources and their knowledge that is creating the synergy, and therefore they're entitled to most, if not all of them. In a highly competitive sale environment, buyers may have to consider agreeing to share some of those synergies with a seller in order to increase the value of the business and get the seller's buy-in on moving forward the transaction. Another financial factor to consider is contingent or accrued liabilities that don't show up in the financial statements and shouldn't, even under GAAP and other traditional accounting approaches. However, such liabilities can have a significant negative impact on a company's operating results and thus impact the value of the business. Common examples of contingent liabilities include potential or even outstanding litigation, regulatory proceedings that may result in fines or additional cost, compliance costs, and warranty claims or guarantees that the company has made regarding their products or services. Common accrued liabilities that are left off the balance sheet are things like earned PTO, other earned but unpaid compensation, such as bonuses, commissions, 401k payments, and then things that are only paid maybe semi-annually or annually, such as insurance premiums and property taxes. This is a very common area for family-owned, privately held businesses, particularly those without strong financial reporting, to miss. Those accrued liabilities and accrued expenses are just not showing up in the target's financials, and they should. As a buyer, you should be alert for those things. You should ask questions and make sure that you understand how expenses are being accounted for and whether all liabilities and expenses are being reflected in the balance sheet. Next slide, please. So we talked about getting reliable financial information, EBITDA, the metric used for transactions. We talked about adjusting earnings, how to assess the quality of earnings, along with a few other financial factors relevant to assessing a transaction. Understanding these factors allow us to determine the single most important factor, purchase price. The most common methodology for calculating purchase price is applying a multiple to EBITDA. But determining the proper multiple sometimes can be tricky. One of the best methods for determining the multiple is using a multiple or the multiple associated with another transaction involving a similar company, i.e. a company of similar size in a similar industry that has the same types of profitability and growth characteristics. However, good comparables can be hard to find, particularly with privately held businesses. So a general market multiple are oftentimes used as a surrogate, or at least a starting point. M&A advisors, bankers, lenders, trade publications, and sometimes just your colleagues in your industry, or those that work regularly on transactions in that industry, can be a good source of comparables and also can provide good information regarding general market multiples. Oftentimes, my experience has been buyers that find a comparison or market multiple that produces a purchase price or a valuation that is higher than what they believe the value of the target business is. However, such businesses oftentimes believe that their business is worth the multiple or maybe even higher than a comparable or market multiple. In this situation, a buyer should look very carefully at determining whether they have an inflated opinion of the value of their own business or if they're failing to properly value the target's business. It could be helpful in seeking the opinion of an independent third party to help make this determination. Next slide, please. If you are a buyer, after determining the purchase price, the next important question becomes, how can you pay for it? Sellers should assess the buyer's ability to pay and how they are paying as well. An offer is only as strong as the buyer's ability to pay, and payment and the terms on which the payment is being offered are also important. There's a number of ways to finance a transaction. Most of you are probably familiar with these. Set them out on the slide. However, some financing options are more attractive than others. But the options that are most attractive to buyers are usually the least attractive to sellers, and vice versa. For example, seller financing is very attractive to, or typically very attractive to a buyer. Cash transactions, or all cash transactions, less so. Obviously, you flip it around. To a seller, cash is king. An all-cash buy or an all-cash transaction is the most attractive option. And although they may be willing to agree to some seller financing, it's much less attractive. Also, bear in mind that purchase price is also negotiated against the backdrop of financing. So sellers, if you're seeking the highest price, you may be asked to assume some risk. via seller financing. This can look like a seller note, could be an earnout, or some other type of deferred payment. It's important when you're looking at these types of seller financing to distinguish between contingent and non-contingent seller financing options. Earnouts are contingent. They rely on the company's future performance, and they're not guaranteed. They're only going to be paid if the selling company hits certain thresholds that are established in advance. Seller notes, on the other hand, defer payment, but they're typically non-contingent. In other words, the seller is contractually obligated, or excuse me, the seller is contractually entitled to receive payments from the buyer just over some period of time on specified terms. When seller financing is part of the deal, sellers should be aware of any other lenders and financing parties and to what extent their claims are subordinated to other lenders. If there is seller financing, sellers should also conduct reverse diligence, and buyers should be prepared to provide seller with the financial information to help give the seller an understanding of the buyer's ability to finance and to service both their bank debt, other financing sources, as well as repay the seller financing. Rates and terms will vary by type of financing, but generally speaking, debt financing is very attractive now. I'm sure Tim would be happy to discuss financing terms and financing structuring with you. Next slide. So we've discussed financial factors. Let's move on and talk for a couple of minutes about non-financial factors. The most important non-financial factor in a transaction is people, particularly the management team or other key decision makers. Why is that? Because people produce the financial results. So from the buyer's perspective, a management team should be measured by three factors: its ability to produce the financial results, whether it's dependent on one or a very small number of people versus a larger team, and whether there's a second tier of managers that are being groomed and prepared to assume leadership roles. And then the third is the tenure of the management team and their commitment to continued employment. The last thing most buyers want to hear in connection with a negotiation of a sale in connection with the purchase of a company is that none of the management team is interested in remaining with the company after the sale. Having the management team remain for at least a transition period is critical to ensure the success of your purchase. From the seller standpoint, you should be aware of these things as well. You should be building a strong team. You should be avoiding overdependence, making sure that you have a diversified team and you're bringing people along that can step into leadership roles going forward. Last, as it relates to tenure, have those conversations with management, maybe even put bonuses in place that give them some incentive to remain with the business after the change of ownership. Again, from a seller's perspective, you should know how strong your management team is and what is the business's reliance on you as the owner's continued involvement. In addition to management, the other employees should also be evaluated to determine job satisfaction and critical skills. In today's tight labor market, a company's ability to attract and retain skilled employees is more important than ever. To the extent that target companies' workforce and management team cooperate to achieve mutually beneficial goals, rather than viewing themselves as adversaries, to the extent that that's the case, the greater the chance the target will continue to prosper under new ownership. Evaluating management employees, however, can be challenging for the buyer. Out of a fear that employees might quit or that customers or vendors might quit doing business with them, sellers are usually reluctant to share anything about a sale with its employees until they are convinced a transaction is a certainty, which is usually at or just prior to closing. So as a buyer, how can you get access? Well, first of all, buyers should request and receive access to key employees. Non-disclosure agreements will prevent buyers from contacting employees without permission, so they should request this of the sellers, but sellers should understand and be willing to provide access to key employees. Buyers can inform sellers of their plans for employees in an effort to convince sellers to allow them to meet with additional employees. This is sometimes helpful for sellers to understand that they can explain a transaction or share a transaction with a buyer without fear of losing key employees. Last, buyers can also avail themselves to some online resources. Glassdoor is one example. Using that kind of service will allow them to get some insight on employee morale, turnover, and job satisfaction. Next slide, please. The ability to acquire or sell a business is often correlated with what's going on in the seller's industry. If the industry is dominated by one or two large players, it is often hard for a smaller competitor to compete with them. So they may not be very attractive targets. However, if a small competitor is doing well, they become a very attractive target for large players, and it may be difficult for a family-owned or smaller company to compete with a large organization for that type of transaction. But if this is the situation, it can be a very attractive situation for a seller. A lack of deal activity in an industry may make it difficult to buy or sell, and activity levels are oftentimes related to the attractiveness of the industry. However, if the shortage of deal activity is due to a lack of demand, buyers should be able to find good opportunities without much competition. And we'll talk more about competition in a minute. Consolidation can be on the other end of the spectrum, lots of activity. In this situation, it's important to decide whether you're a buyer or a seller to avoid a situation where a significant amount of consolidation happens, and then you may be limited in your ability to either be a consolidator, buyer, or sell into the consolidation as a seller. All businesses depend on relationships. Customers, regulatory, vendors, purchasing, employees. It's important to determine the nature of those relationships and to what extent that they would be impacted by a sale. If they are or should be contractual in nature, it's important to determine if such agreements are properly documented, valid, enforceable, and assignable. And if they are assignable, whether that requires consent or not. A seller's reputation in the industry can also provide helpful insight to the buyer. Owners of business are often concerned about maintaining their reputation in the community upon the sale of the business, and buyers should take these types of concerns into account when negotiating with the seller. It can help to minimize mismatched expectations regarding future plans for the business, and may provide the buyer an opportunity to negotiate more favorable terms, including the purchase price, if the buyer plans to run the business in a way that the seller finds agreeable or consistent with how they envision the business moving forward. Next slide, please. So I mentioned competition. In the current market, sellers are becoming increasingly interested in competitive sale processes that involve proactively soliciting offers from multiple buyers. In that situation, a sale process can be narrow and focused on just a few buyers, typically strategic, or it can be a broader process that targets a large number of potential buyers. So I've listed some competitors out here that will typically, you will find as a buyer, you will find that you're competing for target companies or for sellers. Most buyers fall into one of the categories listed here. You may be, as a company, a family-owned business, you may be a strategic buyer. You may be trying to buy one of your competitors. If that's the case, you do have a leg up vis-a-vis other strategic buyers, and certainly a leg up versus financial buyers. Management insiders oftentimes are competitors. However, they oftentimes struggle to finance a transaction and or be willing to take the risk associated with acquiring a business. I've also listed advisors because as competitors, because there's a large number of M&A advisory firms out there that are also initiating contacts with prospective sellers in an attempt to engage them as clients and conduct the sale process on their behalf. So buyers are competing against them if they are seeking to have and initiate conversations with a seller one-on-one, and if they want to avoid a sale process. Obviously, a buyer can participate, a family-held business can participate in sale processes to the extent that they avail themselves of those, but most buyers find that or try to avoid participating in these processes because they feel they have better odds of success outside of a process, and oftentimes valuations will be lower. Next slide, please. While price is usually going to be the most important factor, sellers do appreciate when buyers know their industry and understand their business. Buyers should seek to become as informed as possible about the targets it intends to pursue, and to the extent possible, develop a relation, even if such efforts are limited to attending trade shows or industry events where targets are in attendance. It's important that you become as prepared as possible so that when an opportunity does arise or present itself, you'll be ready. Next slide, please. Studies have found that most family-owned businesses do not have well-planned strategies for making acquisitions, nor do they have good exit plans or any exit plan. So the decision to undertake a transaction tends to be more of a reaction to outside factors than the result of a well-planned process. Examples of some of these outside factors include informal conversations with a competitor looking to buy or sell, a health or family issue arising that causes the owner or management team to divert more of their attention away from the business. An unsolicited offer will oftentimes appear. I'm sure if you're a business owner, your email is flooded with people that have just the right opportunity for you to sell or are offering you to buy, offering to sell you that perfect company. Sometimes change in industry dynamics can happen quickly, and a decision to transact can be a reaction to those types of things. However, a transaction is a very time-consuming activity that takes months to complete and a lot of resources, and there's no guarantee of success. Thus, to the extent that you can plan and prepare, you'll be ahead of the game. Doing so will allow transactions to move more efficiently and increase the certainty of closing. Similar to the stock market, it's very hard to try to time the M&A market. Having said that, parties should be aware of where the economy is relative to the general business cycle and the industry cycle as well. Parties should also be aware of their past operating results in assessing how changes in the general economy affect their business when contemplating a transaction, and whether they're well positioned to take on additional indebtedness to purchase a business, or whether their results are going to deteriorate or maybe plateau, and so during a period of growth or while they're showing growth might be a good time to sell. Although timing should be carefully considered, companies should remain opportunistic. Some opportunities will only present themselves once and may do so, unfortunately, at inopportune times. Next slide, please. Here's the tax and structure slide I mentioned. I think I'm going to skip over that given our timing, and I will turn it over to Mike and for Q&A.
All right, sounds good. Tim Fogarty's on hand as well to kind of collect these questions and ask them as well. Tim, what do you have first?
Okay, thank you, Mike. And thank you very much, John, for that presentation. Very detailed and thorough. Really appreciate it. One comment first, when we talked earlier about financing transactions, this question kind of revolves around what kind of deal teams do you need to set up and put in place when you're looking at buying a company, both external and internal. And, you know, our observation and experience is our clients, when they're looking at doing acquisitions, they bring the deal team. The team's going to work on it in very early, And generally, it is very common that your financial institution, your banker, is part of that deal team and goes through due diligence with you. And that's a real advantage to get that third party look, as well as your other external deal team people, because when you're looking at financing, the more information the bank has on the target company, having gone through the due diligence with you, as well as, because we'll be looking at your company's EBITDA as well as the EBITDA that you're buying, combining those together and looking at forecasts to determine the amount of financing that's appropriate for that transaction. So our advice, bring your banker in early, but what do you see out there on other deal teams, John, both internally and externally?
Yeah, no, I totally agree regarding the bank, bringing them in early. It really doesn't make any sense to go shopping if you can't afford the purchase, right? So having the banker involved is critical. Teams can be, an M&A team can be set up using both internal and external sources, really kind of depending upon the types of personnel and the resources and the time available that a buyer has. If a buyer has a strong CFO, a lot of that work is oftentimes delegated to the CFO, and early on they can kind of get involved. They can help identify some targets. But other firms will use outside advisors, an M&A advisor, to help them identify targets and help them value those targets. Hopefully, as I mentioned, there's an outside accountant involved, using an outside accounting firm to help evaluate not only your capacity working along with the banker, but then once you start identifying and talking to targets, being able to evaluate their financial performance, the target's financial performance, using your accounting firm to do that is very helpful. And that could include a quality of earnings report, similar to what we mentioned earlier. But I would say those are key people. After you get into the diligence, and particularly after you sign a letter of intent, you're going to want to bring your attorney in as well. And we always strongly recommend an attorney with deal experience that's done transactions in the past. Purchase agreements are very complicated, very specific things that most buyers and sellers are not dealing with on a regular basis, and they are very important to allocate risk and to make sure the terms of the agreement and the terms of between the buyer and seller are actually being set forth and agreed upon in a written document.
Okay, thank you. One from our audience, this referred to what you talked about, the contingent liabilities. How is accrued PTO or vacation time viewed and treated?
Yeah, so it will always be viewed as an accrued expense, and it needs to, that can show up in a couple of places. One, it can show up in the income statement, whether you're properly accruing that on a monthly basis or not. And then secondly, there's always going to be periods in which it's accrued but not paid, and that needs to be reflected in the balance sheet. And that's going to be a current liability, and that current liability is going to have an impact on working capital. And back to my comments on working capital, to understand what the true working capital position is and what type of working capital is necessary to drive the business going forward.
Thank you. Could you talk a little bit about the advantages, disadvantages for the buyer and the seller on a stock purchase versus an asset purchase type acquisition?
Yes, sure. So there's two primary concerns here. One is kind of some tax benefits, and the second is liability. On a stock purchase, the buyer acquires the stock, and they step into the shoes of the seller, and that would be their basis in the assets, depreciation, etc. They also step into their shoes in terms of all the liabilities and contracts that a seller has. So in that situation, and the other tax-related consideration, obviously, is that this owners would receive directly the proceeds from the transaction. So a stock transaction can be very advantageous to a seller to avoid what's sometimes called double taxation that occurs with an asset sale. In an asset sale, a buyer acquires the asset from the company, leaves, and the money is now in the seller company, which is effectively a shell, after it sells all of its assets. And then it needs to be distributed, and it would be taxed at that level. It needs to be distributed down to the shareholders or other equity holders, and it would be taxed again at their rates. So a stock transaction is typically preferable for a seller. A stock transaction may not be as attractive to the buyer because they're assuming some liabilities and they don't get a step up in basis, which is a tax advantage to a buyer with the asset transaction. That analysis also needs to be taken into account as to what type of legal entity you are. That's particularly true of C Corps. If you're an S Corp or an LLC and there's pass-through, it's deemed to be a pass-through entity, then it really doesn't matter as an owner whether it's a stock transaction or asset transaction for tax purposes, because there's not a taxable event at the entity level.
Okay, thank you. Talk a little bit about how we have mostly strategic, almost probably entirely strategic buyers in our audience. How important post-acquisition is in terms of integration and culture of the company and being able to carry your culture into those employees and the target company?
It's very important, and there's a lot of studies out there that say that deals are less successful or maybe even unsuccessful if that's not taken into account. In my presentation, I didn't touch on that specifically, but that's really subsumed by your assessment of the people. And are people happy in their jobs? Is there turnover? And how does the business operate? Getting a sense of that is critically important. And I think that even when the cultures are just different, there's not necessarily a bad or good culture, they're just different. Being very proactive to explain what changes are going to be made, why those changes are going to be made, and giving employees input into the transition process can help mitigate some of those culture clash type situations. However, if the culture is that different, and buyers should really think carefully about whether that's an acquisition that fits for them.
One question. Tell us a little bit about what's the market like today? Is it a buyer's market or a seller's market?
Good question. In the middle of a pandemic, you might think that everybody's kind of on pins and needles, sitting on their hands, and maybe we kind of referred earlier to EBITDA. I remember this time last year people started talking about EBITDAC, which was earnings before interest, taxes, depreciation, amortization, and COVID. So some businesses have suffered, but the deal market, there's a lot of businesses that have prospered and or just held serve throughout the entire pandemic. And the deal market is very strong right now. I would call it a seller's market. Valuations are high. The availability of financing is good. The terms of financing are good. All the things that kind of lead to a healthy and robust market are in place. And so the question becomes, is there adequate supply? Lots of buyers out there, lots of cash in private equity, lots of cash and resources available to family-held business as well through their banks and other sources. So that's driven up prices. We talk about the business cycle. We are kind of long into the current business cycle, and valuations and the M&A market reflect that.
Well, thank you. That was our final question, John. I want to thank you again for excellent presentation. I think Mike will talk about this presentation will be on our website today, and John's contact information is also included in that. So I'll turn it back over to Mike and Joe.
Hey, thanks, John, for the in-depth presentation. Thanks to everyone for joining us. John didn't mention strategic planning. We do have a session coming up in August on strategic planning. But in the interim, please mark your calendars for May the 11th at 11 a.m. Central Time. Kurt Chambliss of TMH Financial will discuss using SBA 504 funding as part of your long-range business real estate strategy. Until then, thank you very much.